the return on whole life insurance will beat out Dave Ramsey's money market accounts. And since his money market accounts, which apparently, according to Dave, can't even do 2.4%, is taxable to poor Dave every single year for the rest of his life. So this means that Dave, which I'm sure is making a great income selling ads for term life insurance, by the way, on his show, makes a reasonably good income. Let's say he's going to be in a high tax bracket, okay? Let's presume he's in the highest tax bracket at 39% federal as of this recording. If he earned only 2.4% in a money market account after taxes are considered, he's now only earning a net tax of 1.46% in his money market account. And because it's a money market account, as soon as he withdraws money out of that account, he'll have to pay sales tax or whatever it is he's using the money for. And worse, his return in the money market account is earning him nothing since he spent the money out of his money market account. Meanwhile, I can pull money from my, quote, horrible whole life policy, and it will continue to give me that great middle single-digit tax-free return every single year, even on the capital that I used to make my purchase. So if I have $100,000 in cash value and I pull out $80,000 to invest or to buy a car or whatever, my cash value is going to continue to earn that same compounding growth rate on the full $100,000 as if I hadn't touched the money at all. Now please, Dave, please show me why you can even hold a candle against something like that. Now, could you do even better in your growth stock mutual funds? I know he used to say 12% was what you should easily expect from the stock market. You could just fall off a log in the stock market and find the magical growth stock mutual funds that he's talking about. Of course, you'd have to talk to one of his, Investor Pro, SmartVestor Pro experts, the people that pay Dave Ramsey money to be a part of his Cool Kids Club, Financial Advisors Club, to find out where they're getting their numbers and their portfolio from. But Dave Ramsey himself was caught in that lie too. He now says that his claim that you could earn 12% in the stock market was nothing more than, quote, aspirational, that he just wanted to get people to save more in the markets. Well, the honest answer, according to third-party research, real investors, according to Dalbar, are now earning something under 4% per year in the stock market over a 30-year period. If they had their money tied up in typical index funds, mutual funds like Dave Ramsey talks about. And that's before taxes are even considered. Why? Because average returns are meaningless. And that's all Dave Ramsey wants to talk about. What you want is uninterrupted compounding. I'll even take a smaller rate of return as long as the rate of return is constant, as long as it's never subject to volatility, which causes then less efficiency. I would rather stability over inefficiency. Let's jump to the next part of Dave's talk with Thomas.
If you die, your wife, the beneficiary, I assume, would get $1 million. That's her face.
My daughter. It doesn't matter if she's
okay.
but yes.
Yeah,
correct.
whoever the beneficiary is going to get the $1 million.
Right.
That's
right.
what they're going to get. That's all.
Right.
If you have a cash value of $200,000 at 2.4%, that you put $95 per hundred in to get to $200,000 or to get to $100,000, none of that. So you have a savings account that for the first 3 years you put in there gives you nothing. After that, it pays 2.4%, and when you die, they keep your money.
All right.
Which makes it absolutely horrendous. So you're much better off. And many, many decades ago, the financial planning community, by and large, started moving towards buying term life insurance for the $5 per hundred and doing almost anything else with the 95, but over in the investment world, away from the insurance world. Put it in a freaking fruit jar. At least it's there when you die.
Okay, so we're going to have to go quick here as we're wrapping up this episode. But once again, this next claim is categorically false, and it goes to Dave's ignorance on how these policies are designed. And of course, he even mentions that financial advisors decades ago started telling everyone to buy term and invest the rest. Well, that's a whole story in and of itself, but mainly this guy named A.L. Williams started a marketing campaign called Buy Term and Invest the Rest. And wouldn't you know, he owned a mutual fund company that sold term life insurance. Go figure. If you ask a barber if you need a haircut, you already know what his answer will be. Look back on the Upton-Sinclair paradox, which says that it's impossible to convince someone of something when their salary is dependent on them not being convinced. But even so, is Dave correct? Do they confiscate the cash value when you die, as Dave is famous for saying? His answer could not be further from the truth, but it also goes to his misunderstanding of how any equity contract works. Dave complains that Thomas and his $1 million death benefit would be paid to his wife, and the life insurance company would keep his $200,000 cash value. Is that even a bad deal? Let's talk about it. Think about your house for a minute. Let's say your house is worth $1 million, and let's say you had $200,000 of equity in the house. Let's say you sold that house and you closed down your contract you had with the mortgage company when you sold your house. Okay, so how much money do you get when you sell your house? Well, if you're keeping up with me here, you'd only get the equity you'd built up, right? The house is worth $1 million. You'd paid off $200,000. You still had a mortgage of $800,000. That means you only get what you'd paid off. What you owned was $200,000. You'd get a check at the seller's table, you might say, for $200,000. You would not get the $200,000 plus the $1 million house, right? I mean, that would be absurd. No, you sold your house and you keep the money you built up in equity. That's just common sense. Now that we've cleared that up, life insurance is better than that. In the case of selling your house, all you get is the small number, the equity that you built up. Again, that was $200,000. You lost the $1 million asset, the house. But when it comes to life insurance, your family gets to keep the bigger number, the death benefit. So even on Dave's own terms, we should not buy a house. Instead, we should get as much whole life insurance, according to Dave, as we possibly could afford. But let's keep going. If it's truly a bank on yourself designed policy, the death benefit grows over time, such that when you pass away, your family would receive the original death benefit, plus all the cash value, plus even more money coming from paid-up additions dividends. I'll include a separate policy statement from Pamela Yellen and her website, bankonyourself.com, to show you exactly what would happen and how much she would leave her family, which would be a check for more than the original death benefit and the entire cash value combined. So Pamela Yellen has devoted her entire career to exposing these myths and more on her website. And I highly recommend everyone check that out. And in fact, she has thrown down the gauntlet to debate Dave Ramsey, Susie Orman, or anyone else who wants to challenge her. And anyone who can beat the financial strategy of Bank on Yourself will be paid, get this, $100,000 cash from Pamela herself. That is putting your money where your mouth is, in my opinion. So way to go, Pamela, for putting that out there. Now, Robert Hanlon, is famous for saying, "Never attribute to malice that which could adequately be explained by stupidity." Now, Dave Ramsey is very fiercely against whole life insurance, and yet he clearly does not understand what he's saying. So I'm going to chalk this one up to ignorance rather than to malice. But believe me, there's lots of things in this world I don't understand either. And there's another quote I'll leave you with by Steve Forbes. And I think this one relates directly to Dave Ramsey and his show. The quote is, "It's far more profitable to sell advice than to take it." Whew. Okay, so at the end of the day, Dave Ramsey has no obligation to you or to your family. He is there to cash his check for his show. And I'm sure he believes, and I'm sure he is, doing a lot of good for a lot of people. And that's fine for him. Your job is to think critically about your own financial objectives and discern the truth, rather than maybe only hearing what you've heard on Dave's show or anyone else's show, or even this show, even Not Your Average Financial Podcast. The key is do your own research, come to your own closest version of reality, hopefully, and find that, as I'm sure you'll agree, reality remains undefeated. And in my firm opinion, whole life insurance is right there with it.